Hedge funds are considered more flexible than traditional long-only funds or unit trusts because we have different tools at our disposal that allow us to generate returns regardless of the market environment, compared to a unit trust that normally follows a buy and hold strategy and are normally dependent on the overall direction of the market to generate returns. More importantly, hedge funds are intently focused on generating absolute returns, not relative returns to a benchmark, but absolute returns. Hedge funds is essentially open to anyone to invest, from as little as R1,000 a month debit order or 25,000 Rand once-off lump sum investment.
The mandates of a hedge fund manager is normally pretty wide. It means we get lots of flexibility, it means that we are able to utilize certain things that a traditional long-only fund manager is not able to do, things like shorting, things like using derivative protection, pair trades, etc. And the benefit of that, I think the reason we like to manage hedge funds very simply, is to be able to say then that it gives us more ways to generate the best risk-adjusted returns we can for our clients.
Hedge funds have a larger set of tools at their disposal. We use this toolkit to A, generate returns, and B, manage risk. Our bi-directional investment strategy allows us to generate absolute returns irrespective of market direction. And we can use derivatives such as put options to protect clients' asset value from a market sell-off. Hedge fund managers often invest alongside their clients, which means the investment team goes every day to work to manage their own wealth and the client's money alongside them.
It's really been a volatile market, and volatility is our ideal hunting ground. In this type of environment, you've got clear winners and clear losers, and for a hedge fund manager, we are able to protect when we need to, or also capitalize on opportunities for our investors as they arise. At Peregrine Capital, we manage two primary strategies. Our high growth fund is where we start. It's the fund that includes our best ideas. Our second fund that we run is our pure hedge fund. It's been running for 26 years and it has very low levels of risk. During the entire time that it's been running, the 26 years, it's never experienced a negative year.
One of the more popular strategies as a hedge fund that we implement from a macro perspective is buying put options in situations where there is some macro risk out there. What that does is it protects the portfolio if there is a drawdown in markets, and also gives us the opportunity to engage risk in the event that there is a massive sell-off in markets.
Globally, most hedge funds actually use AI and machine learning to make decisions. At Peregrine, however, we do not necessarily rely on AI and machine learning to make the decision. Instead, we use the tools as a support in our investment process, and it's always been rooted in fundamental bottom-up research that's concluded by the investment team.
While our investment philosophy has been consistent, it's important to keep tweaking it and improving it over time as market conditions change. One of the values that's on the wall right next to me is learn and improve. It's one of our core company values. And I think it's absolutely vital because markets continue to change, technology continues to change. So it's on us to continue to learn, to see where we make mistakes, to improve our process, and to get those things right.
For us, it's kind of a sifting out process to find potential anomalies and then bring in our fundamental research process to see whether these investment opportunities are in fact real opportunities or there's something hidden in there that we haven't found out yet. And I think if you go back over the 27 years, that's what really has played out, particularly in market drawdowns where the portfolio has thrived through those market drawdowns because of the shares that we have in the portfolio and the fact that we have selected the right shares that are built to survive market hiccups.
For us, we are what I call benchmark agnostic. We're absolute return focused. And what that really means is that our clients come to us and say to us, I'm going to give you capital and I want you to grow my capital. And regardless of whether the market goes up, down or sideways, I expect you to use that wider toolkit that you talked about to be able to generate those returns.
So when we look at a company, we try to look at every aspect of it. We try to know that company as well, or hopefully better than anyone in the SA market. So that means looking in detail at the company's financial statements, looking at how much profit they make, looking at how much cash they have on their balance sheet and all those details. So we really try to go through the full spectrum, and there's no stone we try to leave unturned when we look at a company.
We use short sales both from an offensive and a defensive perspective to manage the portfolios. Offensively, we look to take advantage of pair trades, of rump trades, and of outright short sales to exploit and to generate returns. And then from a defensive perspective, we're also looking to actively manage risk at a portfolio level. So we look to maximize the return per unit of risk that we assume within the funds. The implication is that we do not swing for the fences and look to maximize returns by taking on the most risk that we possibly can. You cannot generate returns without risk, and I think assuming well-priced risk is absolutely important in this equation. Well, I think it's important to note that we are adapting the tools that we use on an everyday basis to try and improve our own efficiency, to give us better data, and to enhance the accuracy and efficacy of the decisions that we are taking every single day for the funds. Artificial intelligence is the buzzword of the day, but the more work we do and the more we try and understand it, the more we realize it's not just a buzzword. There are significant implications for the world at large. From our perspective, the most important thing right now is to focus on the investment opportunities within the listed context to understand how this technology is impacting the businesses that we're invested in. This will allow us to identify winners and losers in the market and will help us to make better decisions and hopefully optimize returns for our investors.
What I think truly differentiates us as Peregrine Capital is our people. Peregrine Capital has a very unique alignment of interests with its clients and investors, in the sense that Peregrine Capital is 100% staff-owned, and cumulatively speaking, staff is the third largest investor in the funds. This means that we, as the investment team and staff of Peregrine Capital, are 100% committed and have all the skin in the game and the will, drive and incentive to make sure that we generate the best possible absolute returns for our clients.
The first thing is our tried and tested investment philosophy, which has now been around for close to 27 years. We remain the third biggest investor in the Peregrine Capital funds as a team, and we wake up every day looking to optimize and maximize returns alongside you, the investor.
One of the key things I believe that sets us apart is having a group of extremely intelligent and very driven people 100% going after this goal of delivering great performance for our clients.
I'm very excited about where the hedge fund industry in South Africa is going in the next couple of years. And the reason I say that is hedge as a vehicle is the best vehicle to manage money in, because it gives you that flexibility, because it gives you that toolkit. Talent density in the South African hedge fund market is actually really high. The fantastic thing that we've seen on our journey in hedge in the last couple of years is just how much of a need there is for that talent pool, and how receptive financial advisors, institutional clients and retail clients are to the benefits that hedge funds can bring. So I think there's a very bright future ahead for hedge.